welcome back to MarketBeat Stock Analysis. I'm so glad to have you all joining us today. Home Depot reported earnings for the fourth quarter, and investors did not like what they saw, to say the least. The market followed suit with a big sell-off, leading to speculation that the Fed isn't going to be playing nice with interest rates in the coming months. Today, we'll be bringing you the news of where Home Depot is headed, where the economy is headed, and of course, we'll be sure to check in on Lowe's, who reports later this month. So let's get into it right away. We'll talk about all of that right here, right now. Tell it to us straight, Thomas, clear and simple if you would. After the Q4 results, is Home Depot considered a bad investment?
Home Depot is not a bad investment. It's just bad times for the market. We've talked about this before, Lacey. It's hard to be a holder of stocks now with this sell-off, but this big sell-off is a buying opportunity for long-term investors. You have to remember that as a long-term investor, you're probably going to be building positions over time. That means dollar cost averaging in. You don't want to buy your stocks when they're most expensive so that you have a high average price point. You want to try to buy them when the stocks are pulling back like they are now so that you can get a lower price point over time.
What do you mean by that, Thomas? Are you saying there's going to be bad times for the market or just for everyone in general?
All right, let's pull the charts up. Generally speaking, it's going to be bad times for everybody just because of the pandemic letdown and where the Fed is right now. You have to remember that the price of the stock and the price of the market is based on forward expectations. Starting back here, we can see that Home Depot was in a nice uptrend even before the pandemic started. And then the pandemic caused a correction and a rebound. It corrected because everybody was like, oh no, the economy is getting ready to implode. But what nobody really thought about was that the economy went on a vacation and did not close down altogether. Lots of people didn't even stop going to work. So in many cases, the economy didn't even go on vacation. It just kind of like paused for a little bit. When the reopening started, we got a really quick rebound, and that just gets the market back up into the natural trend. All that stimulus money is seen here and all this flow through. That stimulus money drove an increasing forward expectation for earnings, and that led the stock price higher until the money runs out, and that caused this big correction in the market that we're in right now. We've also got inflation to deal with, and speaking of inflation, this morning's PCE price index was flaming hot. It shows acceleration in the near term and the long term, which means that the FOMC is not in control of inflation. They're still going to be raising interest rates, and they're still going to be pressuring S&P 500 earnings in 2023, and that includes Home Depot.
Thomas, do you think Home Depot has become a no-growth company for the foreseeable future?
I don't know that it's become a no-growth company, but it's definitely a low-growth company, and it's a lesser growth company. In the world where improving earnings outlook leads the market higher, a declining earnings outlook will lead the market lower, and that's what we have right now, is a declining earnings outlook.
So what needs to happen for the market to rally, and in particular for Home Depot stock to rally?
Well, for Home Depot and the market in general, what we need to have is a bottoming in the earnings outlook. When the forward outlook for earnings starts to stabilize and even begins to improve, then the market will start to feel better about the value of stocks. When that happens, we'll start to see a firm bottom form and even the beginnings of a rally.
So can you tell me why Lowe's is trading at 15 times earnings? Like, shouldn't it have more of a comparable valuation to Lowe's?
You would think that it would, but I think in the market's eyes, Home Depot has been more of a high growth company and Lowe's is more of a low growth company. Lowe's also has a slightly lower dividend yield relative to their earnings. And that could have an impact on the valuation as well.
And what about the dividend? Is that a worry at all?
Home Depot still has ample cash flow. The dividend is not in danger. The valuation may improve in the near term, and that may also improve the dividend yield. So in that sense, a pullback in prices is a blessing.
All right, and Lowe's reports at the end of the month. What should we expect from that, Thomas? Lowe's chart is set up similar to Home Depot. Should we be surprised if it falls, or what are your thoughts on that?
I would not be surprised if Lowe's falls. I think that Lowe's results will be very similar to Home Depot's, but maybe with a twist. Lowe's has a better DIY mix than Home Depot. Home Depot has a bigger pro mix. And with the downturn, the downshift, and new home building, that could that could provide an opening for Lowe's to outperform.
All right, great insights as always today, Thomas. Thank you. As a heads up to all of our viewers, we wanted to let you know that we will be doing a standalone analysis on Lowe's later this month. So be sure to subscribe to our channel, hit the notification bell so you'll know when that goes live. If you forgot, just a quick reminder that for a limited time, we're still offering our viewers a crazy good discount on MarketBeat All Access. With everything going on in the market right now, access to MarketBeat's tools and reports are going to be one of the best ways to keep you ahead of the game. Click the link in the description below. Feel free to leave a comment if you have any questions about it. All right, Thomas, thank you again. It's always great to discuss the market with you.
Thanks, Lacey. See you next time.
See you soon.